Monetary policy will be centre stage from a top-down perspective in the coming week, when the European Central Bank announces its latest moves on interest rates and quantitative easing, QE, on Thursday the 10th of December. The ECB runs 3 interest rates, although the headline figure is the main refinancing rate, and that's been held at 0 since March 2016. President Christine Lagarde dropped some pretty heavy hints at the October meeting that the Pandemic Emergency Protection Programme, or PEPP, would be expanded for a second time. The scheme was launched in spring with a plan to buy €750 billion worth of European bonds, and then that was increased to €1.35 trillion in the summer. Some economists have suggested that the ECB could add another €500 billion to the pot as it looks to fight the economic impact of the pandemic and lockdowns, and also struggles terribly to get inflation anywhere near its 2% target. The PEPP has already scrapped some of the limits on prior ECB rounds of QE, in that it can buy more than a third of any EU country's total bond issuance, and can also buy sub-investment grade debt, so it could buy Greek bonds, for example. There is some debate as to whether further wrinkles will be introduced, or whether the PEPP's more flexible mandate will be applied to other European Central Bank QE schemes. Remember that the ECB's balance sheet has swollen to €6.9 trillion, 45% bigger than it was just at the start of this year. That's around 40% of GDP, compared to around a third in the USA and around 40 to 45% in the UK, but way less than Japan's 100% plus, to suggest that the ECB, and indeed other Western central banks, could keep on increasing QE and creating more money for a long time to come if they felt it made sense. Whether you think it does or not, I shall leave entirely up to you. Bottom up, the company news is just starting to thin out a little bit ahead of Christmas, but there are still a few results releases and trading updates on the schedule from a range of large, mid and small cap stocks. Names which may be worthy of further note include retailer Ted Baker on Monday the 7th of December, FTSE 100 plumbers merchant Ferguson and cybersecurity specialist GB Group on the 8th, another retailer Superdry, as well as infrastructure expert Balfour Beatty on the 9th, Ocado, pubs to brewing group Marston's, bus and rail company First Group and FTSE 100 packaging giant DS Smith all come on the 10th, before another FTSE 100 member, aerospace leader Rolls-Royce, rounds out the week with a trading update on Friday the 11th of December. But the company which could just cause the biggest fuss in the week ahead is equipment hire company Ashtead. The FTSE 100 member is due to release its first half results on Tuesday the 8th of December. The shares have continued their long, phenomenal run this year, despite the pandemic and global downturn, even setting a new all-time high late last month. Remember, Ashtead gets around 90% of its sales from its American Sunbelt operation, with the bulk of the rest coming from the A-plant business here in the UK. Perhaps one of the reasons the shares have done so well is hopes that the US economy will turn around quickly, buoyed by monetary stimulus from the US Federal Reserve and more fiscal stimulus from Congress, even if the latter is currently log-jammed on Capitol Hill in Washington. This first half statement should be an informative one, and analysts and shareholders will look to 3 headline figures in particular. The first is sales. On a stated basis, analysts are looking for revenues in the full year to April of around $4.7 billion, a 7% drop down from last year's $5.1 billion. Revenues in the first quarter fell by 7% as well. Also note that Ashtead will release a number which adjusts for foreign exchange movements, and using this metric, the fall in the first quarter was 8% year on year. The second headline number will be pre-tax profit. Percentage growth had been running pretty consistently in the teens before the pandemic, although the rate of advance had begun to slow. For the whole year to the end of April, analysts are looking for a 23% drop in stated pre-tax profit to around £750 million, the second straight drop in annual earnings ahead of what's an expected recovery in fiscal 2022. The first quarter, by the way, showed a 38% slide, so analysts are expecting momentum to improve from here onwards. Finally, analysts will home in on the dividend. Last year, Ashtead surprised a bit by increasing its full-year payment yet again, extending a run of annual increases that dates back to 2005, and it did that despite the pandemic. Now, analysts have penciled in a very small drop in the year to April 2021, before a rebound in 2022. Note that the interim payment last year, as a base for comparison, was 7.15 pence a share. It's probably too early for Ashtead to talk about resuming its share buyback programme, though do watch for spending on bolt-on acquisitions, which came to £246 million in the first half last year, pounds that is, and particularly capital investment. If management's feeling bullish, then it will buy more kit to rent out. In the first half last year, Ashtead spent £815 million. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.